Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveny. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome, everybody, to another episode of the Creating Wealth Simplified podcast. I am your co-host, Chris Seveny, and today I have two special guests. I have Melanie Sikma and her father, Byron McBroo, with One Stop Tax Strategists, and they help business owners pay little tax as legally possible while also continuing to get you to live longer with your money. Melanie and Byron, how are you today?
Good. How are you doing?
Doing great.
Thanks for coming on today. I know this is going to be a jam-packed episode. We're going to provide a lot of information to investors because I know one of the common themes I always see from not only real estate investors, just people in general is, how can I pay less in taxes? That is a common theme. So I guess the first question, let's just kind of roll into, if you want to give a little bit of background about your company, what you do, and some of the dynamics.
Yeah, so my dad here, he's been a CPA longer than I've been alive. So he's got a lot of experience. And I grew up listening to him talk super passionate about saving his clients money and all of his buddies. We'd go on camping trips. And so that's kind of what I never thought I'd work with him. But then I discovered it's actually really fun to save people money. And so that's kind of where it formulated. And then we just found that different entrepreneurs, different investors have different needs. And so that's kind of where One Stop formulated, is where we help them pair them with the best tax professional to fit their needs.
I bet you get a lot of friends when you save them money. You make a lot of friends doing that.
It's funny because a lot of people think it's too good to be true. Mm-hmm. We've had interviews with people where we showed them how to save $90,000 a year, and they just hard for them to believe that their present CPA is leaving that much money on the table.
Mm-hmm.
Yeah.
So that kind of brings up, I guess, the interesting question, because a lot of people always are like, oh, I'm looking for a CPA. I'm looking for a tax professional. Now, what should entrepreneurs and investors be looking for when they're looking to engage with a tax professional?
Yeah. So we find that, obviously somebody that's proactive, but what does that mean? And really, you should find somebody that is going to ask the questions for you. A lot of the times taxes is a world that needs translation. It's a whole nother language. And so you need somebody that's going to ask you the questions that you're not even thinking of. So instead of asking questions to fill out the forms, ask you questions that are going to save you money. And especially just annual tax planning, running numbers at the end of every year, making sure you're not going to have surprises and just being proactive.
And once somebody, I guess, finds that proper tax professional, I know everyone does things a little bit differently. And you've probably looked at prior returns and might have wanted to pull your hair out or shake your head, because I know there's things that are overlooked. Now, what are the most common overlooked strategies for entrepreneurs and real estate investors on their taxes?
We formulated something called our 8-step tax solution. And so we've put that together because we found a lot of people weren't taking advantage of those strategies. Mm-hmm. And the first step, I'd say, is to make sure you get your books in order. A lot of people, they overlook the importance of good bookkeeping and a good set of books. And then they don't realize that that's really the launching tool for all tax planning. You can't do any tax planning if you don't know your numbers and if you're not capturing all the deductions possible. Number 2 is making sure that you have all your stuff in the right type of entity. Dad, you want to talk a little bit about the different entities and the importance of that for real estate investors?
Sure. Most people either are going to be a sole proprietor, they're going to be a S corporation, or they're going to be an LLC. And normally, if you're flipping properties, you should most likely be an S corporation, because that's subject to self-employment tax. Or if you're buying and holding properties, then you want to just be an LLC. Now, obviously, a lot of this matters what state you're in, because some, like Tennessee, has a 6.5% business tax to it. Other states don't have any, or they have a small tax. So there's 4 states which are not that friendly to S corporations: Tennessee, I think Louisiana, New York, and I'm missing one. So I'll have to come back to that one. Normally, if you're buying and holding, you need to be LLC. And then if you're just a regular business, it really depends. I would say if you're making over $70,000 a year, you should be an S corporation. If you're making under that, then you probably just be an LLC. It's important to be an entity with legal protection, though. I just had a client call me yesterday. They have a trucking company. Their son was driving one of the trucks, and he caused a big accident on the freeway in the merging lanes, and somebody got really hurt. Well, they only have $1 million of life insurance with no umbrella. So now they're looking at potentially losing everything they've ever worked for because of one accident. So really make sure you have some liability protection in addition to having a tax savings.
Yeah.
It's interesting because I see a lot of people stay at the proverbial Holiday Inn and provide a lot of like advice, both legal and tax, of, oh, you should set up an LLC, you should do this, you should do that. And from what it sounds like, it's not a one size fits all. There's a lot that has to come into play. And I didn't even realize the state even comes into play too, based on different types of entities.
Right.
Yeah. Yeah. I had a friend that we actually purchased our house from. This was before I knew her, so I didn't pass up giving her good advice, but she had 11 rental properties, got into a car accident and got sued. She didn't have any LLC or any umbrella insurance. She got sued and lost all of them. And that was like their retirement. So it's important to have proper setup, to have something in place.
It's not on our checklist, but an umbrella policy probably is one of the most important things you can do.
One of the first things that people would always mention to me is, you can put everything in LLC or however you want to structure it, but you want to have an umbrella policy no matter what.
Yeah.
That's absolutely something you want.
Yeah. Other things that we find that people aren't taking advantage of, if they have lower tax brackets around them, there's a lot of opportunities there to shift money to lower tax brackets. We call that our ebb tide plan, because an ebb tide lowers all boat. And like, for instance, I get my kids on the payroll. I have a 5 and a 7-year-old, and they're my little models. And so I pay them close to $14,000 a piece, tax free, just different things like that. But the biggest thing is making sure you're talking with your tax professional so that you don't miss out on strategies, because we have a lot of the conversations of the, oh, you did conversation rather than the, hey, let's do this.
A great example of that, using tax brackets around you, is my mom is 90 years old and obviously doesn't work anymore. Actually, she still does the bookkeeping for her church, but we formed a corporation that provides a service to my accounting firm. And what we did is I pay her a profit of $84,000 for that service. And what that means is that 84 it's not taxed to me. So I saved $41,000, but she only had to pay $11,000 on her return. So just by using your family members and people around you's tax brackets, and they might be college students, they might be indigent brother-in-laws, they might be the baby mama or baby daddy, all of those significantly lower your tax brackets.
Yep. And Melanie, you mentioned with the kids, then you can, set them up for a Roth IRA as well. And just have, there's so many ways that this continue to get that snowball rolling, especially for people at a young age, that to me, I never knew anything about this. I remember my first job, basically, it's like, okay, you put in a company 401k. And at that point in time, I think the Roth had just come out and nobody even told me about that. And when I left my job, it's like, oh no, you just have to either keep it or move it to a new employer. You can't self-direct it. There's a lot of other avenues. One of the things I see a lot about, and I hear people sometimes get caught with, and be interesting to hear kind of some of the things that are best practices and some of the things that probably worst practices. For example, people working W-2 trying to claim a real estate professional. I've seen people attempt to do that, and sometimes they get caught. They've been very unsuccessful. So just curious some of the best strategies and some of the worst strategies.
Yeah, definitely all the W-2 people that come and they think that you can do all this stuff, but with the W-2, there's really not a lot you can do. Actually, to touch on the real estate professional, we have a flow chart that we could send people if they want to text us. We could share out the number in a little bit, but we'd be happy to share the real estate professional flow chart to help them decide.
It's difficult for that though, because you have to have 750 hours.
Yeah.
So unless your job is actually in the real estate field, contractor or something like that, it's very, very tough.
Yeah.
The worst practice, I saw this one guy the other day. He came and his tax person told him he was a W-2 employee. He didn't have any rentals. He was planning on jumping into getting rentals. That's why he wanted to talk to us. But his person turned his primary home and had him rent it to his LLC and was just pulling deductions out of his butt, basically. And I'm like, you could get in trouble for that. It's not good at all. So that was one of the bad practices that we've seen. Dad, what's something else you've seen?
Well, one of the things that's really good is just to make sure and set up a separate bank account, have a dedicated credit card. So when you're out there spending money associated with real estate, you either charge it on that credit card or pay for it with that ATM card or check. That way, it kind of puts all your expenses into a pot. Then it's very easy at the end of the year to summarize those numbers up, either for tax planning or to find out where you're at, about to do your taxes. But you just make the decision when you're spending the money, is this a business item or is this a personal item? And just, if you're real super about that, doing your taxes at the end of the year is a lot simpler because everything's in one spot. That's one of the best practices. And then also a best practice is really to meet with your tax preparer or planner, strategist before the end of the year. People come in February and March all the time and they want to do everything possible. I want to be aggressive on this, but the ship's already sailed. You can't have them spend. The secret is to give them a checklist of things to do by December 31st, and then they can minimize their tax. Really, all you can do is in January and February and March is just maybe take bonus depreciation on an asset that they've already done. They can't be proactive.
No, that's great advice of being in touch, whether it's quarterly, semi-annually, but yeah, you don't want to just come, basically first week in January, once, your bank statements get closed out and stuff and put everything in your software, just send that. And that's your first contact with your accountant for the year.
You're really planning for next year at that point in time.
I think another worst practice is I found that a lot of people think that it's the CPA or the tax professional's job to make something a deduction when that's not really our role. Our role is to help you use the tax code to your advantage, but it's not our decision if something's a deduction or not. And so everything's a deduction until you get audited. And so the main thing is to follow the rules and use them to your advantage rather than trying to just fib on things or just sneak deductions in. We've had clients that have lied on we found them when they came to us. They were, what was the guy doing with his books? And then we did the kick the can plan with him.
Oh, what he was doing is he was invoicing his customers, and then he would collect checks before December 31st. And then he was voiding out the invoices, holding the checks till January, then re-invoicing and depositing the checks. Well, what I did with the guy, I showed him examples where people had gone to prison for less than he had done. And then we gave him a list of things that he could do legally and not have to worry about it. And did the same or a better result. Another thing people need to do when they're doing tax planning, especially if you're involved in real estate, is to make sure and discuss with your banker what your minimum income needs to be so you don't do a lot of really good job at tax planning, but kill yourself when it comes to bank financing and you miss out on a deal. We did a plan years ago for a guy when we first started doing a lot of this, and we got him down to where he's paying almost zero tax. But then as he went to go buy properties, he was doing a lot of flips. He had a real struggle qualifying for the flips because we had got his income down so low. So a lot of times we need to talk to the banker, find out what you need to maintain and pay a little bit of extra tax, but it's really just the cost of being able to borrow money.
Yeah, that's the important point of, sometimes doing too much strategy can hurt you down the line where, you can't get that leverage. I want to kind of, rewind a little bit because we briefly touched upon it. And I'd like to kind of have you explain and do a little bit of deeper dive into explaining what a real estate professional is, like what it means, and what are some of the benefits that somebody who qualifies for that can get.
Okay. So a real estate professional is someone that obviously spends a big chunk of their time doing real estate. We have the flow chart, and we'll give you the text number. We can text that flow chart to you, but basically you got to spend 750 hours. If you're a full-time realtor, that automatically qualifies you, and it's either you or your spouse. It's a combination of those hours. If you're physically doing the work on your real estate, that qualifies. But obviously, if you have a full-time job in IT or something like that, and you're working 2,300 hours a year, it's going to be very difficult to get that 750 in because that gets you up to 3,000 hours a year.
Yeah.
So you really need a good logbook if you're on the bubble to show you that. But the benefits, there's a rule that says if you have losses on your rentals, which most of them do because they have depreciation and everything. If you're a real estate professional, you're not subject to limit those losses. You can, for instance, let's say I want to buy an apartment complex for $2 million and generate a $500,000 first year bonus depreciation. Okay. What that means is that $500,000 loss now can offset my W-2 income.
Okay.
you can take a really sizable deduction. Normally, if you're not a real estate professional, that loss carries over and you take it when you have future gains. But if you're a real estate professional, you can take those and get a bunch of cash flow to offset either your business or your large W-2. So that's the real benefit, is being able to take the tax deductions that people that aren't professional can't.
To simplify, it turns your passive losses into active losses, and it allows the passive losses to offset your active income or W-2 income. So it's really powerful if you do have a high earning W-2, if the spouse does a real estate professional status, because that can really offset that.
I'm assuming it's only in like a passive real estate venture. For example, I know somebody who he invested in a company, but it's like an operating company that has losses every year, but I don't think I think there might be like a max that they can take in the losses because they're not active, or I don't know the full story, but he's basically like took $100,000 loss. He's like, oh, I can't deduct it all this year.
Because he was passive losses. Your passive losses can't offset your W-2, or it can't offset your interest and dividends that you make.
Okay.
Unless the loss is related to real estate and you're a real estate professional.
Okay.
If it's just a regular loss, then no.
Yep.
But you don't lose those. They just carry forward till you have gains from it.
Yep. Okay. Another thing that I see some people not realize is when they own real estate in multiple states, and that has potentially some significant ramifications. You want to talk about that for a few minutes?
Yeah,
Sure.
normally, there's a lot of people, it's really the biggest thing is knowing what different states and the laws that the different states have. So it's important to work that your tax professional understands the different states and the laws associated with that, to make sure you're not screwing yourself over or doing anything. It just complicates things a little bit. Yeah, you can add on to that.
We already talked a little bit about Tennessee because they have an excise tax of 6.5% of your net income. Now, normally, if it's real estate, that's not going to be a problem because depreciation losses usually offset the gains that you have. So that's not too bad of a problem. So that 6.5% would be on the net, and only if you're an LLC or an S corporation. But some states, if you live in a high tax state, like we live in California, so if I invest in a state that has tax, if I pay a state tax to say Montana, well, Montana's a bad example because they have zero tax, but if I pay, say, 5% tax to Arizona, what happens is I pay the Arizona tax, but then I get a deduction off my California taxes for the amount I paid Arizona. So if you live in a high tax state, it really doesn't cost you that much to invest in other states. If you live in Florida, Texas, one of the zero tax states, then you're actually going to start, and you invest in California, you're going to be paying your California taxes even though you don't live in California.
Yeah.
So it's just something to be aware of, and just find out if you're looking at buying out-of-state properties, which most people don't buy out-of-state properties in California because their houses are too expensive. But if you need to find out the rules on that state, just something so you have in the back of your mind when you're making those purchase decisions.
Yeah,
And or if you're going to have a large capital gain.
Yeah, because I've had people ask like, oh, I own property in 3 states, and they realize they have to file returns in those
States,
3 states and not realize, oh, I thought I owned. I'm like, nope, you got to file in every state you own the.
Yeah. It doesn't mean you shouldn't do it. It just kind of overcomplicates or it complicates the situation a little more.
So there's the traditional real estate, but something that's gotten really hot over the last few years. And I haven't played in this market or game, but I'm just curious to hear short-term rentals, because those are operated differently than I think a long-term rental. So are there different tax implications on a short-term rental versus, a long-term 12-month rental?
Yeah. So short-term rental is going to be taxed with active income or as active income. So actually short-term rentals can offset your active income from other sources.
Okay.
And so I think it's a little more work. I've never done either, so I don't know. But from what I hear, it's a little more work to manage. But that if you're netting over 70,000 there, we'd create an S corp and all that stuff. So it can offset your active income. Yeah. So there are different rules where long-term rental is more.
But short-term rentals are subject to self-employment tax.
Yeah.
Which is Social Security tax, is 15.3% of your net amount. Now, a good strategy for short-term rentals is, let's say you buy some short-term rentals, you want to make sure you manage them the first year, because there's a carve out for short-term rentals that if you do that, you're allowed to take the losses against your W-2. So you manage it the first year, and that way you can take those losses. You take bonus depreciation in the first year, and then after that first year, you can convert it and have somebody else manage them. But if you can manage them in the first year, that allows you to take those losses against your wages. That's a really good strategy for W-2 people, where normally there's no strategies.
It's also easier to justify, like if you wanted to get your kids on the payroll in a short-term rental, it's a lot easier to justify a modeling expense, where long-term rental, once you get a tenant, there's really no modeling expense.
You mentioned something a few times, and just for our listeners who may not understand it, but bonus depreciation. Can you explain, what bonus depreciation is?
Dad, I'll let you do that one.
Okay. What the bonus depreciation is, when you buy a piece of property, let's say I buy a house. Mm-hmm. And when you buy that house, you break it into components. You might have appliances you're buying. You might have carpet you're buying. You might have doors. You might have landscaping. There's all these different things. With bonus depreciation, when you buy it, you're allowed to take first year write-off and write off the whole thing. What's 80% this year? It was 100% last year. But anything that has under a 20-year life, like carpet has a 5-year life, 5 or 7. A door might have a 5 or 7 life. I think landscaping is a 10 or 15 or 20-year life. But anything that's under the 20 years, you can take all in the year purchase. Now it's times 80%. Next year it'll go down to 60. But you can take a massive tax deduction in the first year of buying something. Mm-hmm. But you have to be an active manager of that property. You can't have someone else managing it, because then you're a passive person and you can't take the losses. But that way you can take those massive losses in the first year and then convert it to have somebody else management when you've used up the largest chunk of all the bonus depreciation that would come through.
One thing I think some people sometimes ask a lot about is, when you take this bonus depreciation, correct me if I'm wrong, but you're basically lowering your cost basis. So when you do sell the asset, you're paying it back then, but you're going to be paying more in tax than, because you took that depreciation, correct? Unless you 1031.
Well, you're going to get the money up front, and then you have the interest-free use of that money for several years. And then, you're going to pay it back. But we actually have other strategies when you go to sell properties to help you avoid the capital gains. Mm-hmm. And one of the big strategies for real estate investing is, normally when you take depreciation deductions on a property, you're getting a deduction at ordinary income rates. So ordinary income rates in California, for example, are up to 37% for federal and up to 13% for state. So that's a 50% tax savings. You pay 50% tax. The beautiful thing is, when you sell the property and only pay capital gains tax, you pay a maximum of 20% capital gains plus the 13%. So you're getting a deduction at 50%, but you're only paying it back at 33%. Okay. That's just one of the basic tenets of real estate investing and how the law is structured to benefit you. So even if you don't take the bonus depreciation, you really get a lot of benefit from doing that.
And I recently saw somebody make a comment, and curious, they invested in a syndication that took a bunch of bonus depreciation up front, and essentially they got completely wiped out in foreclosure and lost everything. So their $100,000 investment essentially went down to zero. And they made a comment like, great, I lost $100,000, but now I have to pay back the bonus depreciation or something as well. It's like almost like a double whammy. Was I understanding that correctly?
Well, what happens is they probably bought a leveraged investment. So let's say they put $100,000 down, but let's say they bought a $500,000 investment.
Yep.
So they put 20% down. So let's say they took bonus depreciation, and let's say it was a mini storage place, because you get 50% bonus depreciation.
Okay.
So they put $100,000 into it, and they took a $250,000 tax deduction.
Okay.
But they still owe the $400,000 in debt. But what happens when the place got foreclosed on? On a foreclosure, your sale price is considered the amount of debt that you had.
Okay.
So they had $400,000 in debt, which was the sales price. Their basis was the $250,000, which was the purchase price of $500,000 minus the $250,000 of bonus depreciation they took. So that would have generated $150,000 of taxable income on the foreclosure, which is brutal, because you don't have the money and you don't have it's called phantom income is what we call it.
Okay. Ouch. People always are trying to, and it's kind of like, for me, I view this episode, it's like a good potpourri of back and forth of things, popping in my head, and things come up. And, another one talked about kind of deferred income, which I know 1031s, but another strategy a lot of people do with real estate is using a self-directed IRA. So I'm sure there's some unique strategies of using a self-directed IRA, make sure that you can continue to grow that income we'll call it tax deferred, and also make sure you're not paying, UDFI or any other type of taxes on any of that. So just curious to get your opinions on some strategies there.
Yeah. So one of our clients, he's a wholesaler, and he puts his options to tie up. This is with a Roth, but he puts his options to tie up the property inside of the Roth IRA, and then he sells that option inside of the Roth IRA. And so that makes the gain non-taxable. And you could do that 5 times a year per Roth IRA. So he does this with 2 of his kids, 2, and then his wife, and then himself. And so that saves him a ton of money, and that we found is really clever.
With 4 people, he can have 4 Roth IRAs. They can each do 5 properties apiece. He makes an average of $25,000 when he does that. So that's almost $500,000 he can make tax-free, properly structured. I thought that was pretty clever.
Very clever. And I will just make the comment on this that while we're taxing tax strategies, we're not providing tax advice as part of this episode. So always consult with your tax professional as part of that. We always stipulate that. Same thing with attorneys. It's like, this is an attorney, but it's not your attorney.
And like you said, it's very personal. Everybody's situation is different. And so it's important to check with whoever you're working with to make sure that they apply to you.
We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at 7E, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@70investments.com to learn more. Thank you.
As we wrap up this episode, is there any final thoughts or things that, whether it's unique strategies or just, again, disaster stories that you've seen people do, to share with people before we wrap up?
My final thoughts is I think it's always important to get a second opinion, making sure that whoever you're working with is doing the best job, just because it's amazing how many people I talk to that we actually wrote a little booklet that we could send out if we want. But one of our chapters or the little sections is called Bad Advice is Everywhere. And especially like Instagram days, TikTok days now, you'll find bad advice everywhere. So it's important to not DIY your taxes. It's important to make sure you're getting second opinions, just like you would if you were getting an estimate on your housework or if you got a bad health diagnosis. It's important to just check and make sure you're doing everything properly. And so that's kind of one thing we always say is just making sure you're getting a second opinion, doing your due diligence to making sure you're in the right situation as best as possible.
And actually, if anybody would like a copy of our booklet, you can just text it to the number that we provide.
Yeah, the number, I could provide that right now. It's 209-924-4192. So it's 209-924-4192. If you text that, we could send you the real estate flow chart or a booklet and get you guys some information your way.
The one thing that I'll share as someone not as a tax professional or doesn't want to be a tax professional is just remember tax professionals are like doctors. And what I mean by that is they have certain specialties. There's certain tax professionals who don't really understand a lot of the things you can do with real estate or a lot of the creative ideas with real estate or self-directed IRAs. They're more of nothing wrong with this. Hey, you got your W-2 and, some of your income and so forth. Hey, I'll do your taxes for you. Some may be better with operating a business. And then there's others, just like a gastro versus an oncologist or brain surgeon. There are very different specialties as well. And that's one thing I strongly recommend, like Melanie mentioned earlier, kind of a questionnaire. And when you're interviewing and talking with that tax professional, that they understand you and your business or what you do.
One of the things people can do too, and if you can provide the website, Melanie, but we've created a site, taxsavingsestimator.com. And you can actually go on there and plug in, and it takes about 3 or 4 minutes and plug in and just answer the questions. And we'll show you this is just low-lying fruit. We'll show you what you're leaving on the table. And just to let you people know, though, that this is really meant for people that have a business. If you have Airbnb, if you have a lot of rental properties, this can work for you. But you can just plug in here and get just a quick estimate of what you're leaving on the table for the low-lying fruit. There's probably going to be other savings, but this is just the easy stuff. It'll address a lot of things that we talked about today.
That's taxsavingsestimator.com. And I'm just curious how long you've had that URL, because I would have thought that would have been gone a long time ago.
I know. We haven't had it that long. We got lucky.
So So they've got the website, they've got the text where they can. Any other ways you want to let people know how they can reach out to you?
Yeah, what we could do is put in the show notes just some links, but we have on our Instagram, my personal Instagram, and then One Stop Tax Strategists. We post just tax tips. I try to do daily, and so those just a good way to just get little tips and tricks. We have a newsletter as well. If they text the 209-924-4192, we could get you on the newsletter. And purely that is just to give you tips and pointers. We just try to provide as much information as much as possible.
They can also email Tiffany at One Stop Tax Strategist if you're interested in booking an appointment and doing a free assessment.
She could do that through the text too.
Okay.
Yeah.
And all this information will be in the show notes for everybody. Melanie, Byron, thank you for joining us today on this episode of the Creating Wealth Simplified podcast. Really enjoyed talking taxes.
Thanks for having us.
Appreciate it.
Thank you. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.